Hello and welcome to the Gold Goats and Guns podcast for February 20th, 2024. My name is Tom Luongo and we have a lot to talk about. It is episode 170 and I have with me today a guy I had on over the summer. We met for the first time. We had a great talk and we left it off saying this is part one, and then part two never happened because we're both really busy, and that's Brent Johnson of San Diego Capital. Brent's back today and we're going to try and pick up a little bit where we left off while updating where we think we are in the whole interest rate cycle and how that affects geopolitics and everything else. So, Brent, how are you this morning? Let's get started.
Good. Yeah. Thanks for having me on. It's been like you said, about 6 months, and we've been planning to do this, but we're finally getting around to it. So it should be a fun conversation.
It should. And I'll make sure that we do this. We don't wait another 6 months, because I think with the way things are going and the way markets, I think we both, before we started recording, we both kind of laid out where our heads are, and we both feel that we're kind of standing on an island together, going, guys, I don't think that the market's properly priced. That there's a fundamental mispricing in our bond markets, and then that affects equity prices and affects everything else. But so let's start there. What do you think is? I know you're a long-time dollar bull for lack of a decent replacement, if nothing else. Where are we in that process?
Well, I think we're smack dab in the middle of it. I mean, I think I did this debate a week ago, on the fate of the U.S. dollar, and the reality is until there's a replacement, the dollar's not going anywhere. That doesn't mean that the dollar is a good currency. It doesn't mean that it's a moral system. It doesn't mean that that's the way I want it to be. It's just the way it is. And, it's part of the debate. One of the things I said up front was, listen, I'm a money manager. I'm not talking philosophy. I'm not talking, how I would like it to be. I have a portfolio that gets marked to market, and the timing matters. And if you're in my business, if you get the timing wrong, you're wrong, full stop. And so, the people who've been calling for the demise of the dollar for 30 or 40 years, it's not that they're wrong. Eventually they'll be right, but you can't manage money based on that. And so, I feel like right now where we're at, I'll say, and I've said this isn't the first time I've said this, but I am not certain what's going to happen. And I've been doing this for 25 years, and this is about the most uncertain I've ever been. But really? the one thing I have high confidence in is that the people who are certain are wrong. And what I mean by that is, we came into this year with the expectation for 7 rate hikes, or 7 rate cuts.
Right.
And it's not that I don't think that the Fed can cut. The Fed can cut. Maybe they cut a couple times. I don't think they're going to cut 7 times. And if they did cut 7 times, the market would have to be priced dramatically different to force them to cut 7 times. In other words, they're not going to cut 7 times, or it's very unlikely that they cut 7 times with the market at an all-time high and unemployment at an all-time low, right, and inflation still not down to where they want it to be. Mm-hmm. Now, can it happen? Yes, it can happen. It's just that it's unlikely to happen. And that's just dealing with the U.S. We've got a number of other catalysts outside the United States that could cause this to all go wrong as well. So I just kind of feel like the markets, for the most part, are priced to perfection. And I feel like it's a very imperfect world. And so it's not that things can't continue. It's just that the risk of them continuing, I think, is much higher than the market is pricing in.
No, that's a really good way of putting it. I have a slightly different view on a lot of these things. I don't manage money directly, but we do publish a newsletter every month, and it has a model portfolio in it, and I would like that portfolio to do well, and for my people to get good advice, right? So, and I felt that same pressure when I first started working for Newsmax, and I used to be one of those guys, the dollar's going to die, and blah 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 blah, and then everything was wrong for 2 years, and I'm like, if I want to continue doing this for a living, I'm going to have to up my game, because my game is clearly not up to snuff, right? And it's when I realized that there's a bigger world out there. And so, I'm thinking about this now from I look at what happened in November and the massive run we had in rates. It was the buy all the things November and December rally into the end of the year. And I always ask the question, cui bono, who benefits from this? Well, clearly the Fed doesn't technically benefit from this because they're being kind of blackmailed into doing something they don't want to do.
Right.
So who benefits from this? Well, clearly the Treasury benefits from this because they're running a massive budget deficit, and clearly the European Central Bank and the European banking system benefits from this, from having a cheaper dollar, lower rates, which keeps the lid on rates over in Europe because Lagarde is
Correct.
actively has a program for doing yield curve control to control credit spreads called a transmission
Right.
protection instrument. And yet the euro continues to defy gravity at $1.08. So to me, I always looked at that was unsustainable because all that had
Right.
to happen was the economic data in the U.S. to come in slightly better than expectations, and then all that whole narrative is very brittle and would just fall apart immediately. And then once we got past the end of the year and we got end of the year book squaring and everybody sets up for their new investment portfolio, their new investment theses for 2024, they're going to look and go, the Fed's not cutting rates 7 times this year. Like, you're out of your mind. And lo and behold, we've given back the SOFR futures curve has given back 3 rate cuts in 6
Yeah.
weeks. Okay.
Well, and what's interesting to me about it is, and then so you're right. So that has been a big change in expectations, and currencies have moved as a result. Like you said, the SOFR curve has moved as a result. The bond market has moved as a result. What has not largely moved is the equity market. The equity market has largely held up. Now, again, the equity market is being led by the Magnificent Seven or some of the Magnificent Seven. Even those are starting to kind of get a little shaky, right? But so far they've held up. And so to me, the most mispriced thing, again, from an expectations standpoint, is equities. Now, I want to say something here because a lot of times when people hear me talk about this, they'll say that they think that I'm like a perma bear,
Right.
and I'm not. I actually think that equities are going to go a lot higher in the future. But
Yep.
I think right now, markets trade on expectations, and I think the expectations that the market is pricing in are not going to be met. But in general, I would say part of the reason that I think that they have held up, it's not just the Magnificent Seven, is that the Fed has indicated that they're going to cut. Now, they haven't indicated that they're going to cut 7 times, and they haven't indicated that they're going to cut imminently, but they have indicated that they're going to cut. And if you have a market that is, again, maybe not under the surface, but on the surface, doing pretty well, you got low unemployment, you've got businesses that are doing well, and you have a Fed that says it's going to cut, that is kind of a tailwind for market expectations to go higher.
Sure.
Now, I think when those expectations are not met, that's when equities roll over. But I think that partly explains why they have held up perhaps longer than, again, the SOFR curve and the bonds and the currencies. When I first started in this job, people used to tell me that, and I think to me, it's proven true over these 25 years, that the equity markets are the stupid guys and the credit markets are the smart guys. The bond market are the smart guys. And so the currency guys are the smart guys. And so, the fact that currencies have reacted and bonds have reacted, but equities haven't, to me, that's maybe the dumber money still hasn't quite caught up to what's going on.
Maybe. I want to throw something else at you to think about at this point. I'm not arguing with you that equities haven't moved, and maybe there's a good reason for that. The Dow did go on a pretty significant run going into the end of the year, and so it makes sense to kind of consolidate those gains and think about it. And if you look at the Dow, which I do, like I look at the weekly chart of the Dow all the time, and I think we're creating kind of at this point, it's mid-February, we're creating a kind of volatile consolidation pattern now in this 38,000 area on the Dow. And I only really watch the Dow because I do agree with Martin Armstrong that the Dow is the thing to watch if you're interested in what's happening internationally. Like, what's international money think of the United States?
Right.
And I also track kind of for my patrons now weekly, what was the relative performance of like the DAX, the Dow, the NASDAQ, the Eurostoxx 50, the Nikkei, in emerging markets. Let's just do that every week and just to see where they are. And I can tell you that the last couple of weeks, everybody's outperformed the Dow. But the Dow has outperformed everybody else for months previous to that. So it's a normal thing. And if bonds are getting hit overseas, and the bonds aren't just selling off here in the United States, but I think it's just a natural rotation trade for places where the rates haven't caught up and become positive yet. Not positive real rates haven't occurred in Europe, in Japan. And because of that, we're still seeing a rotation out of bonds and into equities. And then some of that is leaking into our equity markets. And I think every time you see the Dow try to sell off, it's met with a very strong bid. It's kind of like gold trying to break down below 2000. There's a very strong bid just underneath this market, just out of sight, that every time the market tests it, we find out about it. Oil below $75 a barrel is a classic example of a market that's just like, yeah, no, you will. I'm not sure about $90 a barrel oil, but 75 is right out.
Yeah.
You know what I mean? Like there are certain levels that are certainty, and I think the more we look at what lows are being made recently, will tell us where the market's head, where the smart money within the dumb money of the market is their head is. What do you think about that?
Well, yeah, and I tend to agree, and I think what you're sort of describing, not exactly, but what you're sort of describing is similar to what I've described as the milkshake, where global capital wants to come into the U.S. because even though it might not be perfect here, it's treated better here than it is elsewhere. And so I think that partly explains this continual bid for U.S. equities. What's been the struggle for me, or what's been the most frustrating thing for me, is that for all the reasons you just described, or at least for many of the reasons you just described, I think U.S. equities are going to continue to outperform in the years ahead, and they will perform well when the world starts to dismiss or sell sovereign bonds. So my thesis has been we'll have a sovereign debt crisis. People will repudiate sovereign bonds, and that money that normally went into bonds will go into large cap U.S. equities.
Thank you.
I
mean that is like for the first time in a long time, I get to sit down and talk to somebody who agrees with me. Yeah, it's such a rarity. So
and I don't have to feel like an idiot. There's a couple of reasons for that, but what's been a struggle for me is that there's short term, there's medium term, and there's long term. Long term, I think we're in for a really, really hard time. In the medium term, I think the U.S. does pretty well relative to everybody else. In the short term, I think equities need to get a correction to take some of the froth out of the market, and then perhaps the Fed then has reason to cut, and then perhaps that provides a tailwind to equities to go higher again to new, much higher highs. And so I've been battling internally with my belief that U.S. equities do really well in the years ahead, but in the short term, I think they need a correction. And one of my friends mentioned to me, he said, what if this is happening right in front of you and you're waiting for this correction that never comes? And that's true. It might not come. I think it will, but it might not. So I'm not short. My clients, we own equities for our clients, and we think people should own equities, but we don't think they should be all in on equities with markets priced the way that they are.
And it's a really good point you bring up, and I'm glad you brought it up, because I also think that there's a good solid probability of a significant correction, say on the Dow back into the 35s or something like that.
Yeah.
And then I would turn around and say, but what that will fuel is a reorganization within the equity markets. We will see a rotate out of overpriced. We'll see rotations possibly, like we're doing this, and NVIDIA is about to do their earnings. I mean, it may even be today. Yeah. Right. I can see a rotation out of overpriced stocks like NVIDIA and into undervalued other equities, but the money, all it does is move around. Because remember, you said markets trade on expectations. In the short term, they trade on momentum and sentiment.
Yep.
And if momentum is still there, the Momo guys are going to keep bidding the market up because they're only interested in following the momentum, and that feeds sentiment, and those two things play off of each other until somebody says, you know what, that's enough. And then we put in a high, we get an emotional high, and then we're going to start testing lows. And that's what I'm beginning to think that we're looking at, that you and I are both looking for that moment as to whether or not we're going to get that signal.
Well, and here's the thing that I think a lot of people miss, and it took me a long time to understand this, and that so I'm not. The reason I'm saying it took me a long time to understand is because if anybody doesn't realize this, don't feel bad, because it's normal not to kind of understand this. But I think a lot of people are looking for what's the catalyst that's going to send things lower. Well, the reality is you don't need a catalyst to send things lower. You just need an absence of new buyers showing up.
Yep.
So if everybody is in, the reason that markets typically turn after everybody is in is there's nobody left to come in to push it higher.
Right.
Right. And so, some people say, well, maybe it'll be NVIDIA earnings or maybe it'll be the Fed meeting. And, maybe it will be, but it can also just be a lack of no new catalyst to push it higher. And
Yeah.
when no more money can come in, then things start to sell off. And so, and I'm the first to say, I don't know whether we're going to have a negative catalyst or we're just going to have an absence of new buyers. But I just think that there will come a time in the not too distant future that we are going to have a correction. Now, I am currently of the opinion, and I always reserve the right to change my mind, but I am currently of the opinion that this is a dip to be bought in U.S. equities if and when it comes.
I agree.
Now, again, I might change my mind, but as of right now, I'm saying it's a dip that will need to be bought because I do think capital will continue to flow into the U.S. and U.S. equities will be seen as a relative safe haven compared to other options around the world.
What I'm going to say in support of that, because I agree with you, is that what you watch is what I do is I read the political tea leaves from the mindset of the international investor who looks at, where to place his money and is looking at the relative, clown world, quotient for their particular markets. Like who's got where's the least amount of clown makeup being applied to the political system every day. And when I guess that's probably the best way to put it. And once you do that, because that's what, real smart money overseas is doing. They're trying to figure out, okay, if my place is solid, I'll stay here. If not, I'll go somewhere else because I can. This is what the Bank of Japan is going to start fighting very soon if they don't start allowing the long end of the yield curve to rise, for example. And this is the long-held thesis that Japan is in serious trouble. I happen to think that Japan has enough cash reserves to defend the yen and force the conversion, and they're just going to move they're going to start selling bonds or allowing bond yields to rise and allow the equities to go higher. But they're going to defend the yen because I think the Bank of Japan is signaling they're going to defend the yen. That being said, and again, that's a minority opinion.
Yeah.
But I think it's a reasonable one given the history of the Bank of Japan. So with that in mind, that's why I'm watching the political situation here in the United States and how we handicap the presidential election and all this other stuff in the primaries, because I think that is good. That's the signal that everybody is looking at to try and figure out whether or not they can buy that dip when that dip shows up.
Well, the little add-on I would say to that is if you're right and the BOJ decides to defend the yen and the yen strengthens, and if the yen strengthens versus the dollar, but the dollar strengthens versus everything else. So let's say you've got the yen and the dollar rising versus all other currencies. That's about as bearish scenario for capital markets as I can paint, because that's for global markets, I should say.
I was going to say, for whose capital markets?
Right. Other countries, even developed markets and emerging markets, I think would suffer tremendously.
Yes, they would.
Under that. And the U.S. and Japan may outperform on a relative basis, but I think that would be a nightmare for emerging markets because there's huge carry trades done using the yen as a carry currency because interest rates are so low. You can borrow the yen for free. You go put that somewhere else, and even if you're only making 1 or 2%, you lever it up, and now all of a sudden you're making 7 or 8%.
Yep.
And but if the yen starts strengthening, that gets pulled away pretty quickly. And then, the capital leaves those carry trades. It rushes back into Japan. It helps Japan, but it deprives everybody else of that liquidity. It's kind of a similar type thing when the dollar rallies. It puts pressure on other countries. So there's so many different. I mean, it's really fascinating what's going on now because central banks around the world have kind of painted themselves into these boxes. And they again, it gets back to what do they want to do and what are they capable of doing, right?
Yes.
And it's not always the same thing.
I know, I agree. I'm glad you made the point about Japan and the carry trades and all that, because that's been part of my argument for a while now, and this is why I've been looking at Europe in particular. And I think that the difference being that Europe needs a stronger euro in order to continue to keep their inflation costs their inflation under control because of their energy. They got to keep the price of energy low as priced in
Yeah.
euros. So same thing exists for Japan, except Japan hasn't gutted their industrial production. They're and Japan has the reserves to continue to do so. I think that Europe has been spending their reserves actually quite egregiously, because I tracked the TIC report and I see that the Eurozone has been a massive net buyer of U.S. Treasuries
Yeah.
for 2 years now, to the tune of something like $600 billion net, FYI, across the entirety of the Eurozone and all the British protectorates and all all the stuff that would be a British protectorate, like Bermuda and the Bahamas and the Virgin Islands and the rest of them, the Caymans. And so when you factor all that together, I think it's clear that in my mind, what I'm seeing is that Europe is beginning to run out of other people's money. And so when you said it's bearish for capital markets, the first thing I think of, I may just have Europe on the brain, because I don't like communists, because I don't, that Europe is the one that's in serious trouble here. And when I keep hearing reports about this, everybody's worried in the United States is worried about the commercial real estate valuations, and that causing a credit crisis of some form here in the U.S., a banking crisis. Well, I'm hearing multiple reports now that there are multiple German banks that are in serious trouble who are exposed to the American rollover in commercial real estate. So,
I mean, when I look around the world, it's hard to pick out where I think a crisis or some kind of a volatile event comes first, because there's numerous places where it could happen. But in general, I think Europe is just in a lot of trouble. And I've said this for a long time, so this isn't anything new. And I'm not just saying this to agree with you. I think what's happening in Europe, I think Germany is being systematically deindustrialized on purpose as a matter of policy by the U.S., or largely by the U.S. and largely by some European factions. Now, I don't think Europe likes this, but I don't think they really have much choice. And this gets down into the real politics of, how countries work and, the power of a hegemon. And I think the U.S. has the power to do this to other countries. Now, it doesn't mean that the U.S. is perfect at it. It doesn't mean the U.S. doesn't make mistakes. But, I remember a couple of years ago, people were telling me that, if push came to shove, that Germany would side with Russia and use their cheap energy and they would leave the West. And I was like, you're crazy. That's not going to happen. The Europe is so integrated with the United States that, it would be almost impossible for them to leave. And, then the argument would be made, well, that's really going to hurt their economies. And I'm like, yeah, it is.
It is.
and yet it's going to happen anyway. And you can kind of see this happening now. Germany and much of Europe is largely in a recession, or at least headed there in short order. And, they don't have their own way to defend themselves. They don't have their own way of providing energy to themselves. And so they are largely a vassal to the United States. And people hate it when I say that. And I don't say it because I like it. I just say it because I think it's true. And I don't think that's going to stop anytime soon. So, can Europe do a few things on the margin to better themselves versus US? Sure, they can to a certain extent. But the idea that, that they can kind of, without a lot of pain, become this sort of sovereign continent that no longer needs the U.S. to help them, I think is wrong, and I think the U.S. is currently exploiting that.
I have a slightly different view on that, but largely I agree. I believe that that's why the Europeans basically run the Biden administration. I will be honest with you. I think that what we see, I see from a regulatory perspective, what they've been doing is trying to destroy the comparative advantage the United States has over Europe, while at the same time trying to bind us down in a bunch of border wars, or a bunch of their border wars for them, in order to continue hollowing out our economy and our political system in order to keep capital from fleeing. And I think that I don't think there's any air gap between Janet Yellen and Christine Lagarde. I've openly called Janet Yellen a traitor who was working with Christine Lagarde to keep Europe from imploding, and at the expense of the American taxpayer, because that's why they're spending the way they spend. That's why they, can't stop throwing money into Ukraine or to this or that. All of these things I was thinking about this the other day because the story about Eurobonds for militarization just came up on yesterday. And the EU Commission is desperately trying to do fiscal integration because they need to, because they don't have direct taxing authority in order to undergird their debt markets, right? So they absolutely need to prove to the world that they have political control over all 27 member states in order to be able to ensure that to the investors, hey, look, if you buy our bonds, we will be able to tax and we will be able to keep everybody in line, which is why I think they raked Viktor Orban over the coals over the Ukraine aid. I didn't even think it was about the money. I think it was just about the show of solidarity first, because the goal was always to issue Eurobonds. Now, these Eurobonds are to rearm Europe and to turn the French and German military industrial complex into they want to be the military industrial complex of Europe. And I think that, but at the same time, they still want the United States to run NATO and fund NATO.
Yeah.
And you can see the tension here. And I think that's a very big thing. And looking around the Munich Security Conference, everybody was talking about how NATO is our sacred honor and our sacred duty and blah, 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 blah. Well, of course, for now. So, you know what I mean? And I think these things are all, we can't talk capital markets until we talk about these things, because honestly, our central banks so thoroughly dominate capital markets at this point.
Well, they do,
and that we can't. We have to talk about the relationship between them in order to be able to understand where we have any clue as to where I think capital markets are going to go.
Well, I think that's a very fair way to put it, and it's particularly frustrating for me because I'm a free markets guy. I believe that free markets are infinitely better than centrally planned markets, but the world that I live in, I wish I could manage money in the free market, but I don't. Right. And so I don't have the luxury of ignoring politics, and I don't have the luxury of ignoring central bank policy and monetary actions taken by monetary authorities. I mean, it's a crucial part of what I do now. And I think, to your point, it was several years ago, probably 10 years ago, maybe even more than that now. It's, you know, during Draghi's famous, you know, whatever it takes speech. Mm-hmm. It was around that. I don't remember if it was in the same speech or it was around that time. He made some comment that, you know, regarding the potential breakup of the euro. He said something to the effect that do not underestimate the amount of political capital that has been spent to keep Europe together. Right. And I agree with that. Like, it is a political union. It is not an economic union. I think they call it an economic union kind of as a smoke and mirrors to make everybody think it's like this good market-based thing. It is not a market-based thing. It is very much a political. And if it was a free market, they would have split up a long time ago.
Absolutely.
Because the pressures are just too great. And I ultimately think they will end up breaking up anyway. But then, I mean, that's a whole other topic. But to your point, they are holding things together from a political perspective, because from an economic perspective, they're falling apart. Yep. And this guy who participated in the debate with me last week, kind of on my side, that, you know, the dollar was not going to anything, Michael Every of Rabobank. Mm-hmm. I'm not sure if you're familiar with him or not.
I am.
He's very smart, and I think he's done a very good job of kind of laying things out kind of as they are, as opposed to the way they would like me. But he made a comment at some point last year. He said something to the effect that, you know, for 30 years we were on this globalization effort, and the thing that mattered most was who could produce the most efficient widget at the cheapest price, and that's what everybody would buy. Everybody would go buy the cheapest widget at the best price, or the most well-produced widget at the cheapest price. And he said, but then we had COVID, and now we have a fracturing world, and that is no longer the most important thing. In other words, decisions are no longer being made purely based on economics or profit. They're being made based on political desires and power, as opposed to just pure profit. And he said, as a result of that, everything changes. Mm-hmm. And I think he's right. I think he's, and again, it doesn't mean that when you start talking, you know, politics win over economics, that can last it doesn't last forever. Eventually economics will win. Eventually mm-hmm. markets win. but that can take a long, long time. And
Yes,
the
it can.
example I always use is, the Soviet ruble lasted for like 70 or 80 years.
Yep.
So and if somebody at the very beginning said, well, this isn't going to last, well, they were right, but their whole lifetime passed them by before it actually failed. And I think that's important to keep in mind now because, well, I think a lot of the stuff that these, governments are putting in place and monetary authorities are putting in place, I think they will ultimately fail, but it might be 5, 10, 20 years down the road before they do. I'm not
Absolutely.
smart enough to know the exact timing. And as a result, the fact that I know that these things can last longer than you think they can, again, I don't have the luxury of just ignoring them. So all this stuff that you're talking about, this is all stuff that I try to pay attention to and try to think through. And, it's all relative now, or it's all relevant now. You can't ignore this stuff.
No, Brent, you're absolutely right. It sounds like you and I've gone through a kind of a similar path. I've been saying since I first started this that there's the world I want, there's the world I've got, and the
Yep.
world I've got kind of sucks. And frankly, and
Yep.
I am I'm a hardcore free market kind of guy, and and I understand that but this is the world we live in, and when you sit back and you think about your own personal journey as to what you thought about various events in history that you lived through. And I'm thinking like through like the gold bull market from 2002 to 2011, and then all the debt crises in Europe and and 2008. And I start to rethink them, reframe them as political events as opposed to economic events.
Yeah.
It becomes a completely different version of history.
Yes.
And I'm not saying it's the only frame to look at things through, but it is worth doing because
Right.
again, there's an amalgam of those two things. Those political and economic forces are constantly at war with one another, and then they're being moved. I love the fact that you brought up Draghi's statement about how much political capital has been put towards Europe. Like, there's a reason why Christine Lagarde runs the ECB, and before that was put in for charge of the IMF.
Right.
It's not that this
Right.
woman is in any way, manner, shape, or form an economist.
Right.
She's a lawyer, and she's not even a
Yeah.
very good lawyer, and she's a criminal. So she's there because she brings with her the imprimatur of massive political capital,
Right.
and that's what is going on, and then that's what she represents. And then you have to ask, okay, well, you have her and you have Jerome Powell. So now let's look at Jerome Powell and then think about what we think is going on with Powell and the Fed and what his philosophy is. And you think about where he came from, who he represents, and then, run your incentive structure based on those things and, and the organization that he represents. And to your point about the dollar's not going anywhere because everybody's assuming that the Fed is powerless to stop this. That is a dangerous assumption in my mind. And
Right.
I think you agree with me.
Yeah. Yeah. I tend to. I actually have a question for you on this because I was thinking about what conversation we'd had
Right.
because during our last one, I think we had similar takes, but they were very slightly different from a nuanced perspective.
Yep.
And you were saying that Powell was fighting against the Davos crowd, essentially, right?
Yep.
Do I have that right? Okay.
Yes.
So let's take that as that being correct.
Okay.
For argument's sake, let's take that because I don't totally disagree. I don't know that I 100% agree, but let's say for the sake of this conversation, let's pretend that's right.
Okay.
If that's the case, I would imagine that he would want to continue being in the position he is in order to be able to continue that fight. So in other words, he either has to maintain his chairmanship position for the next few years in order to accomplish this goal, or he has to accomplish this goal in the next 6 months before a new president comes in and perhaps he gets either not reappointed. Right?
Well, he's in the position until 2026. Because he went in. So even if Trump comes in, so he has until February or so of 2026.
Well, so this is where we probably disagree. I think from a factual standpoint, you are correct. But if a new president doesn't want him in there, I think he has the power to get him out of there. So
he would. I think it
would be very difficult. Anyway,
yeah, it would be. it would be possible for someone like Trump because I know Trump doesn't like Powell, but I think it's a
Right.
personal thing because he thinks that Powell was raising rates during COVID to torch his presidency, to
Yeah.
his reelection campaign. When I don't think that's the case at all. I think that if Trump were to get, let's create another assumption. Ready?
Yeah.
Set of assumptions, which is that within the context of if Powell is doing this to quote unquote save the dollar, save the United States, force fiscal discipline, and all the rest of it, that someone's going to take Trump aside this time and say, look, he's going to start cutting rates to make you look good as you enter power. So I need you to shut up.
Trump would love that, right?
Yeah, and that's all. And that's the only way. And so that's when Jamie Dimon takes him aside and says, "Look, this is what we're doing. This is what we have to do to break these people." And we're going to. So Powell will start loosening monetary conditions in order to support in order to support you in the presidency, which is why I come down politically. He'll start, if he has to cut rates, he'll cut rates somewhere in the second half of the year.
Okay, so we're in agreement then, because that's that's the point I was going to try to get to, is because even though I think that Powell is happy to have a tighter monetary policy than most people think, I also think he is not against loosening it in order to keep his job.
Well, yeah, keep his job, or, look, it's like everything else. As I said to you before we started recording today, everybody keeps using the word pivot, which frankly is a little long in the tooth, because 2.5 years into a rate hike cycle, that's kind of now we're ready for the other part of the cycle, right? Which is the loosening part of the cycle. So the question is he going to, when people talk pivot, they're talking about crisis, back to the zero bound, more QE. That's out of the question. But if Powell cuts 75 basis points after raising 550, that's not a pivot. That's just normal.
I think we're on the same page there.
Yeah.
I think we're on the same page there. Well, and especially, and here's the other thing is I think people need to think about this too. And I was having this conversation with a friend of mine a week ago, is that, he was saying, if the Fed starts to cut, doesn't that kill the milkshake? And I said, well, not really, because we're not going to have a world where the Fed is cutting and everybody else is tightening. So if the Fed starts to cut, Europe's going to be cutting as well. Asia, China's been doing all kinds of things to stimulate their market. They're not all of a sudden going to start hiking rates in a scenario where the Fed is cutting. So, again, my argument has always been on a relative basis, and the U.S. does not have to keep raising rates to keep the dollar strong.
No.
You can actually have a dollar strengthening during a rate cutting cycle if everybody else is cutting as well. And one of the examples I use, and this is admittedly an extreme example, but I think it shows how quickly things can change, and you don't need tight policy in order to have a strong dollar, is that at the early part of 2020, the dollar was around 96 or 97. We started to have trouble from COVID. The Fed cut rates at the end of either the end of February or very early in March. They kind of did a surprise rate cut. I think they did it over a weekend, and the dollar went from 96 to 94 very quickly, the dollar index. And on March 9th, the dollar index was around 94, 95. And 10 days later, on March 19th, it was at 102.
Yep.
and that was despite them saying we're going to do whatever we need to do. So when things start to go the other way, markets can move very fast. And when things go bad, the dollar goes higher. And so, I just don't see how we get into a situation over the next 5 years where the dollar goes down versus other currencies and kind of stays there. But if they are able to do that, let's say, when I say they, I mean central banks, governments kind of working in policy or in coordination, if they're able to get us to a period from, let's say 2025 to 2030, where the dollar bounces around between 80 and 95, then I would say that it's largely a bull market because, and things are fine and we don't have a crisis. Because I think if we have a crisis sometime in the next 5 years, you're going to see the dollar going higher with it. And that's why, even though I'm sitting here saying I'm not necessarily predicting a crisis, I think it is more likely than not. And I don't have the luxury of ignoring this possible crisis, because I think if the crisis does come, it won't be a minor one. I think it'll be a rather big one.
Well, interesting you say that, and I agree. I think that if there's going to be a credit crisis, I don't think it starts here in the United States. So we've got to, I know you've got to run in about 15, 20 minutes. So
Yep.
I want to shift gears a little bit,
Sure.
because everybody's now pointing towards the end, that March. There's some big cliff that's happening in March. We have the BTFP is going to end, the bank term funding program. The reverse repo facility is supposed to be drained by then, blah, 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 blah. All this is going on. But at the same time, remember that the BTFP, I think, in my opinion, was created to offset, to give banks another program to avoid the stigma of using the discount window. And they were willing to pay the extra 10 or 15 basis points in order to avoid that stigma. And the Fed has come out literally and said, we're going to force you to use the discount window at least once a year to get rid of the stigma, because we're getting rid of the BTFP. What the Fed is saying is that we understand that there's probably a crisis in the future, and domestic banks will have access to the discount window, and you can't think of it in the old terms anymore. The nature of the game is changing. We also have some changes coming to the way the repo markets are going to work in terms of posting U.S. Treasuries as collateral for repo transactions, and no more rehypothecated leveraged Treasury. You're going to have to post 100% collateral now, which is going to change the demand curve for Treasuries tremendously as well. What that says to me is that the Fed is doing exactly what I expected them to do. We are shoring up, and we are going to defend the American banking system while the rest of the world's banking systems melt down. We are forcing this on the rest of the world. I've been saying for 2 years that Powell's goal is to break the leveraged offshore shadow banking system, because he wants control over monetary policy. He wants the Fed to be in charge of its own monetary policy. This goes back to what Jeff Snyder's talked about for years in Eurodollar University and all of that stuff. Well, if that's the case, which I never argued with Jeff that was that he was correct on that. Where I argue with Jeff is that the Fed doesn't have any tools in the toolbox to regain control over its own monetary policy, and that the Eurodollar system is not a free market versus the Fed's central planning. I think they're both central planning of a different form. And so that being said, I'm trying to update the map here. So when you look at this all signs here are that the Fed is inducing a credit crisis on those that think they control the price of the dollar, and the Fed wants control over the price of the dollar.
Well, so I totally agree with that. So I think what I would say is, as a way of framing this, and especially for people who are kind of new to this, I don't think any monetary authorities or governments are in total control. Right? And they are largely reactionary agencies. Having said that, I think the Fed has much more control over the global monetary system by far than any other institution, right? So when I say they have control, and somebody says, oh, they don't have control, they just react. Okay, I won't argue that point, you're correct. But the idea that the Bank of Japan has more control, or the Bank of China has more control, or the Bank of England has more control than the Fed, I'll argue against that all day, every day, because the Fed can largely set monetary policy for the whole world, unless the other country wants to destroy their currency. In which case, let them do it.
Right.
And so, so I do agree that they have been putting programs in place and making moves in order that if and when they choose to do so, they can better, or at least better than they were a couple of years ago, be able to protect the U.S. banking system to the detriment of the rest of the world. So I think, and I have argued for a long time that the Fed uses monetary policy as a weapon, and I think they will continue to do that. And I think these moves that you've highlighted will allow them to do that to an even greater extent.
Right.
And I've had people say yes, but Brent, if they do that, then the rest of the world will just sell all their U.S. dollar assets. And my point is, okay, so let's say, and as a result, U.S. asset prices will fall. Okay, so let's just pretend that that's correct. Well, what if the Fed did they instituted another BTFP? They called it something else, and they said U.S. banks have access to it. Maybe it's just a discount window, right? But foreign banks don't,
Mm-hmm.
right? So and they did some kind of a QE thing as well. Let these foreigners sell all the U.S. assets. Let the Fed buy them. Let the banks buy them. Let the banks post their bonds that are falling at par. And again, this is not good for the U.S., but compared to the rest of the world, which would be completely melting down on a
Mm-hmm.
relative basis, the Fed is taking control of the dollar.
Absolutely. You're
Yeah,
you're absolutely correct. And these
yeah,
are all the scenarios that I've played out in my head multiple
yeah,
times as well.
yeah.
And I've been, again, just kind of assiduously trying to find the programs and the things that they put in place in order to have that the ability to manage the transition. What I think that they've done is I think Powell's done this very, very well, is to manage the transition from zero bound and QE to QT and positive real rates from a CPI perspective, not from a real,
Yeah.
maybe not from a real inflation perspective, but certainly from a CPI perspective. And I got news for you, folks. If the United States gets a significant amount of political reform this fall, which is, I think, driven behind the scenes by powerful players on Wall Street and the banking system making that happen, as opposed to what we've been used to for the last 20 years, which is to watch the globalists gut the country. If we actually see the political shift supporting the monetary policy shift, then I got news for you, folks. Everybody's going to look at 5.5% on 2-year U.S. Treasury bonds and going, or 2 U.S. Treasury notes, going, ooh, that looks good to me.
Yeah.
Like, and by definite, and by exam, and by and I can either buy 5.5% from there, or I can buy 5.5%, or I can buy 11% from Thailand. I'll take 5.5% in the U.S., please.
Well, okay. I'm
That's, I
glad you
mean, that
brought.
it doesn't makes no sense to me.
I'm glad you brought this up, because this is, sometime last fall there was a chart going around that showed the yield on U.S. Treasuries was now on par with emerging market debt, and the chart was a little bit misleading because there were many emerging markets were still yielding more than Treasuries, but the point was that the U.S. is now, similar to an emerging market. Its debt is being repudiated, and the U.S. will no longer be able to fund itself, and especially because they're going to have to sell even more bonds. That's going to push the yield even higher. And in my opinion, everybody was completely misinterpreting this chart, because the idea that the world, and again, maybe not you as an individual, maybe you as an individual will not loan money to the United States government because perhaps you don't like the system, or you think they're a bunch of clowns, or whatever the reason is. But it doesn't really matter what you as an individual do. What matters is what the system as a whole does. And the system as a whole, who has to have treasuries to operate anyway, if they have the choice between getting 7% from a U.S. Treasury or 7% from Thailand or Egypt or South Africa or wherever it is, they're going to take the U.S. Treasury. And that liquidity flowing into a U.S. Treasury at 7% deprives the emerging markets and other countries of that much needed capital and that liquidity. The reason those countries offer a higher yield is because they need the liquidity. So if that liquidity is not going to them and instead is going to the U.S. government, it just, again, the squeezes global liquidity out from around the world and squeezes it into the United States.
Mm-hmm.
And lack of liquidity is death, right? Yep. That's what causes crisis. So, if people are thinking that the U.S. is going to continue to run a budget deficit and the interest expense is going to continue to rise, and therefore that's horrible for the United States, in the very long term, yes, it is. But in the short term, that's just going to pull even more capital to the U.S. and allow them to weather whatever storm is coming better than its competitors.
Yep. And it's during crises, it's during moments like that when you reach crisis points. I was watching a talk with, it wasn't John Mearsheimer, it was somebody else. It was Neil Howe of the Fourth Turning.
Mm-hmm.
And he was saying, one of the things that, look, do we ever reform existing systems during quiet periods? No. During quiet periods, we're all like, do you quit that job that you don't really like, but you're comfortable because it pays you more than enough money? Yes. And then it's only when the job is now either gone or is about to be gone, and then you can see the crisis looming, or you're in a crisis, do you change your behavior? We're not going to change our behavior until there's an actual crisis. Right. So if a crisis begins to emerge in commercial real estate here in the United States, yes, we are reaching a crisis point fiscally. 7% of debt to GDP, budget deficits, is a crisis period. It's not sustainable. Not right. At 5.5%. So that's forcing a political crisis on Capitol Hill. You see it every day. It does. I can sit here for the next 20 minutes and hog the microphone and explain all the little things that you're seeing, right? They're all out there. Mike Johnson's 2-week recess to stop the Ukraine aid bill that he doesn't want to pass, and then he does a photo op with Donald Trump like last night. Like, it's, like you can see it all, folks. Why is Kevin McCarthy not the Speaker of the House? Why is, why is Lindsey Graham changing his tune? Yada, yada. You can see all these things. Like, it's right there in front of you. The crisis is we're in the political crisis. It's happening. So the reform is underway, and if Powell and company navigate the monetary thing and the liquidity thing, even with a reasonable degree of aplomb, we're going to wind up, as you've pointed out, kind of weathering the storm while everybody else gets the worst end of the stick. The wild card is them taking us to war, right, and forcing us to fight a multi-front war against military powers that are not going to be pushovers.
Right. And one again, something else I would point out again, to your listeners or to mine who are somewhat new to this, is that, for 30 or 40 years, we had the pendulum was swinging towards globalization and cooperation. Mm-hmm. And, sometime in the last 5, 10, 15 years, I think you could debate when it actually started to swing the other way, but it is without a question swinging the other way now.
Yes, it is.
But it has a long way to swing, right? And part of the reason I would agree with your characterization that the Fed is trying to get control of the euro dollar or the dollar, and not want it to be not for them to be as reactionary as they have been, is because they know that this pendulum is swinging the other way. And it's not just based on the U.S. trying to bring things back to the U.S. And it's not just the U.S. policies, against Russia and China. China is doing this as well. I don't think people realize that China is trying to close itself off from the rest of the world as well. And Xi has been putting policies in place and has been reorganizing things in a way that he can protect his domestic economy as well. So this is not all done by the United States. And even if the United States wanted to keep it a completely globalized world where everybody was cooperating, it wouldn't happen because the rest of the countries are not cooperating either. So we are headed towards a system. And again, whether this happens in 5, 10, or 15 years, I don't know, but we're heading back to a system of regional blocks as opposed to one big global economy.
Agreed.
And from that perspective, part of the pendulum swinging towards globalization and cooperation was this huge growth of the euro dollar market, and where the world as a whole used one currency, and that was based on the dollar. They call it a euro dollar, but it's based on the dollar. But as the currency, as the pendulum starts to swing the other way, that euro dollar, they're trying to replace it, right? The US is trying to replace it, and the rest of the world is trying to replace it. My whole point is they don't have a replacement for it. And the fact that they're trying to replace it without a replacement in hand is what's going to cause the crisis and is what's going to cause the volatility. And so, even though I think the US has the ability to control that crisis better than anybody else, it doesn't mean I think they have the perfect ability to control it. There will obviously be many unintended consequences. It doesn't mean that the U.S. won't get hurt. You may get. I'm in my 50s now. I'm 52, so I'm a kid. I'm a child of the 80s. So I'm often referencing many, movies or songs or videos from the 80s, and the one I've started using recently was the Hagler versus Hearns boxing match.
Okay.
I think I was about 13 years old when that match took place, and there's these two welterweight, two of the best fighters in history, and they had this fight, and it was like a Rocky movie. If you haven't seen Hagler versus Hearns, you should go on YouTube and watch it. And the reason I bring this up is because in the very first round, Marvin Hagler got hit by Hearns above his eye, and the cut was so bad they almost had to stop the fight. Somehow, during one of the changeovers, they got the cut to stop bleeding, and in the third round, Hagler knocked out Hearns. So Hagler ended up winning. And that's kind of the analogy that I've been using, is that I'm not saying the U.S. isn't going to get hit. I'm not saying that the U.S. isn't going to bleed. They probably are going to get hit. They probably are going to bleed. I just think that they're going to win in the overall match. And I think a lot of these moves that Powell is making, and that some of these policies that are being put in place are in an effort to win that overall battle.
Yep. I like to use the line from Dr. Strangelove from George C. Scott. Mr. President, I'm not saying we're not going to get our hair mussed, but the estimates are 20 to 40 million dead tops. Yeah. But they're going to get wiped out. Like, you know what I mean?
Well, the sad thing is that they think that way.
I know.
30 million, okay, no big deal.
I know.
And if you don't think Z thinks that way, you're crazy. And if you don't think Putin thinks that way, they all think that way.
They have to think that way.
They have to think that way.
So one of the things, Brent, I really appreciate you putting a different, in many ways, a different spin on a lot of the things that I've been saying. The one thing I will say, going back to China, I noticed during the 11 years of ZIRP and QE, that China was always out of phase with everybody else. That when the West was in a loosening cycle, China was tightening, and when we were tightening, they were loosening. Because we weren't always just loosening, right? We were doing round robin QE around the G7, but we are seeing a little bit of that now. And the PBOC is what they're doing to manage their credit problems now, is what they always do, which is to cut the reserve requirement rate. And they use that as their primary monetary policy tool during any kind of real estate crisis. But yeah, absolutely, is Xi trying to pull back on the quote unquote globalization Chinese markets? Absolutely, he is. And the interesting, and I just to close it out, I go back to Japan. I think Japan is the wild card. If the Bank of Japan is still in the orbit of the Fed as a wingman or fellow traveler or whatever you want to call it, and all the incentives are there for them to do this, then when the timing is right, Ueda is going to come out and he's going to allow the long end of the Japanese yield curve to rise above 1%. Right now, the markets are so mispriced that they're forestalling this. Right, the Japanese 10-year is still trading about 72 basis points, 75 basis points. But watch for that move above 1%, and watch for the Japanese yen to be intervened if it tries to push above 152. Because every time it gets anywhere close to that, the Bank of Japan will come in. They have always done so. Whether they'll be successful in the long term or not is a different story. But for the next 6 to 9 months, I think that's the wild card, I think, for capital markets.
Well, and I think, as I said earlier in the show, if we get a situation where the yen is rising versus the dollar, but the dollar is still rising versus other currencies, hold on to your butts, because it's going to be quite a ride. Brent, this has been a great talk. I think you said you wanted to keep it under an hour, so we'll leave it here. This is part 2, folks. We'll do part 3 in a couple of months. And I do mean it'll be less than 6 months. Let's just put it that way. So I really do enjoy chatting with you, Brent. It's a lot of fun to not just to get somebody who sees the world similarly to me, but sees it differently enough that it provides a good contrast and context as to what's going on. And to remind everybody that a lot of what Brent and I just laid out in this, Vince Lanci and I have laid out in terms of Vince's arguments about it being a return to mercantilism and gold, is one of those, is something that he and I have explored in multiple episodes of the podcast as well. And one of these days, maybe we'll do a 3-way between the three of us, you, me, and Vince, and that'd be a hoot, by the way.
of a roundtable discussion. So,
well, thanks for having me, and good luck in the months ahead.
absolutely. If you want to let everybody know where they can find you and what you do,
Sure.
use this shameless plug thing, Brent. You're more than welcome to.
Sure. So my contact information can be found on my website, which is santiagocapital.com. It's just a landing page. I don't have a bunch of stuff up there for regulatory purposes. I also do a weekly show with my friend John Cutsmeda. You can find us on YouTube if you go to Milkshakes, Markets, and Madness, or you can go to Twitter. It's @MilkshakesPod, and then I'm pretty active on Twitter as well. You can just look up Santiago Capital on Twitter, and it's a white seashell, my logo. And anyway, happy to interact with you on those platforms.
Absolutely. Thank you so much, Brent. You have a great day, and we'll chat again soon.
All right. Have a good one. Bye-bye.
Thank you. Well, that'll about wrap it up for episode 170 of the Gold, Goats, and Guns podcast. I really want to thank Brent Johnson for a great conversation, taking the time out on a Tuesday morning to chat with me about these things. And as I promised, we'll do this again in the very near future, because I really do enjoy talking with Brent. It's always a stimulating conversation. It really is. So with that said, as always, you can follow my work at my blog at tomluongo.me. You can follow me on Twitter at TFL1728, and you can sign up over at Patreon.com/Gold, Goats, and Guns, where you can sign up for just the twice weekly market reports and private blogs, or you can add in the Gold, Goats, and Guns monthly investment newsletter, where we also put together an entire portfolio strategy for you to try and make sense of what's going on in this insane world. So with that said, we'll see you soon. You guys be well. You take care. Keep your stick on the ice.